Okay, we are now to test two review. This will just give you an overview of what we're looking for. I'll hit a few highlights of something if it comes up, just to give you an idea of what for sure to cover. This is not the end all. There are Quizlets, there are other things that just kind of help. Again, as I've said, having working knowledge of this to weed through the question and pick the best answer is better than memorizing and regurgitating. So that's my effort here, is to try to give you good, broad understanding of how it all works. So that's where we'll work. We talked about consumer credit. Credit is considered buy now, pay later. Um, Advantages, convenience, safety. It's good for emergencies. You build credit. To get a credit card, you have to have credit. To have a credit score, you have to have credit. That's an advantage. Disadvantages are the temptations to overspend, temptations to buy things you may not need, to be a impulse buyer, and just buy stuff because it's there and you can see it and you've got a card and get it now. And then there's also debt risk, of course. Shopaholics and young adults are the most vulnerable to use credit and to overuse credit. They're the most vulnerable to use credit. They're most vulnerable to overuse credit, and the reason is because shopaholics, if they have that credit card in their pocket, are just if they're out buying, they're going to buy. If they don't carry cash or they don't have something on them to do that, they a lot of times rethink it. If they have to pay cash and or use their debit card to realize how much they're paying down, it kind of stops that urge to want to buy. And young adults are an easy prey for getting credit cards, for giving credit cards. And when we're younger, we just haven't learned all the responsibilities that come with having credit and a credit card, etc. And we want so many things, and it's hard when we're starting out. I've mentioned that in a couple of things. When you go from an apartment to your new job, and you've lived in a dorm or something like that, and nothing that's wrong with the dorm. The way I emphasize that, it sounded funny. When you lived in a dorm, and then you go to that, you have to have a bed and a couch and a chair, and you have all this stuff, and it's hard for people like me who want everything at once to turn around and get a chair this month and then get a chair next month and then get that kind of thing. So that's where credit comes into being overused, because you could just go ahead and get it all now, and then you're paying on it for quite a while, which is never the fun part. So college students are also a huge major credit card target. You probably know that better than anybody. They always have been. So don't feel like you're special and unique. You are special, but and you are unique. But they've always targeted college kids. They're a good target market. They don't have a lot of income coming in. They need a lot of things. They want to play. They want to eat. They want to party. They want to travel. You want to do all these things you can do, and you've got to have cash to do that. So credit enters the door and gives you an option to do that. Co-signing. Remember, if somebody wants you to co-sign on a loan, or you need somebody to co-sign with you, if you're the co-signer, you're guaranteeing that loan. If that person can't pay, you are responsible for that loan and that debt. So you want to be very careful who you co-sign with for that reason. Installment credit, that's what we look at, like with car loans or house loans, or appliances. It's a fixed payment. A lot of times with appliances, you may put on your credit card, but if you buy it at an appliance store, they'll tell you, hey, pay me $200 a month for 10 months and you'll have this paid off. It's basically just a fixed payment. So I think of cars are the thing I think of the most with that, because you go in and you choose your car and you get it, and then you have a payment. You have so much to pay a month, and then you pay it off at the end of 3 years, 5 years, whatever you finance it for, 7 years. Credit cards are considered revolving credit because they have a limit, and you can put credit on, pay credit off, put credit on, pay credit off. You don't have to go apply for a new loan or a new credit card every time if you've paid it off to use it again. So that's what's considered revolving. It goes in circles. Smart cards, we talked about how most of our credit cards now, what they call a smart chip, but they're coming out with actual smart cards that store all of our information, health, um, work history, all those things in the chip that's on the card. Now, our cards that we have don't have all that on them yet, but they are working that direction. So, they're chip enabled data storage is what they are. And you hear about chips a lot of times in the news. Um, I usually jokingly go and salsa, um, but they're just basically a microcosm thing that gets embedded in your credit card or gets embedded in a computer that has massive amounts of data storage. Debit cards, when we use them, we talked about they come directly from your bank. When you use it today, that money's coming out of your checking account. It's not like a credit card that you're going to buy now, pay later. Debit cards are instant withdrawn from your bank, cash out. When you're looking at credit worthiness, they look at your debt to equity ratio. The lower the number, the safer it is for lenders. So if it's a low number, the lenders think you're a good risk. If it's a high number, they may question that. Lenders look at your credit capacity, and we can work on building a strong credit rating that help offset that too. Again, they look at 20% of a ratio of your take-home salary for all credit for mortgage payments, this kind of stuff. So we talked about the cost of having credit. One of the things is a finance charge. That'll tell you the total cost of borrowing. Key terms you want to remember our annual percentage rate, because you want to compare apples and apples. What is their annual rate with any fees or finance charges in there? Interest methods to calculate is either prior balance or average balance or ending balance. And so depending on, there's a couple of questions that ask you to calculate the interest on that. There's a calculator in HonorLock, or you can use one that you have there and just show it at the end, of course. But anyway, to do an interest calculation, the basic one is amount times interest equals interest charge. So if you have $1,000, you have 2% interest. It would be 1,000 times 0.02, and then that would equal $20. So that's how much interest would be charged. Now that if it's prior balance, then it'd be the balance. Prior balance was $1,000. If it's average balance, in my example, the average balance would be 1,000. If so, they'll give you those figures in the formula, and then you just figure it out. Common formulas to calculate interest are simple, which we just did, or compound. And we talked about compound interest, especially when making payments to something, how it adds up quicker with compound interest. The same thing happens if you're making payments to a credit card company. A lot of times they'll charge a compound interest instead of a simple. So they're looking at what your cumulative balance is times your average balance, and so they're looking at a compound interest, and then they charge interest on that whole amount instead of just taking, today's balance is 5%, is $1,000, so it's just $20. They would have 1,000 plus the $20 interest, and then multiply that times 2%. So those are the two basic rates of formulas to calculate interest are simple and compound. That also is on the test. Simple interest is the amount times the interest rate. Compound is the amount times the interest rate for a period, blah, 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 blah. If you have to calculate that, usually you can divide it, etc. If it's for a year, let's say it's $1,000 times the 2% interest that we just had above, which would be $20. But then we need to know for a period monthly, so that's for 1 month. But if the interest rate is 2% for 12 months, we would do $1,000 times the 2% divided by 12 months, and that would mean that we pay $1.66 a month. So that's what they'd be looking at, as $1.66 a month going in, and then they would calculate interest on that going forward. So, but you don't have to do that part. Interest-free periods, if they guarantee you that, hey, 60 days interest-free, 1 year interest-free, whatever, that requires usually that you pay it in full at the end of that time, or if not, interest will be charged or has been charged. So if you're going to take advantage of something that has no payment or no interest for 60 days, pay it off in 60 days so that you can be sure you do that. For tips on managing our debt, we talked about one of the best ways is to pay more than the minimum amount due. That always helps you, because typically the minimum amount due is probably just going to be interest. And then, so if you can make interest plus a payment, if you can look at your statement and figure out what the interest for the period is, make sure you're at least paying the minimum interest, and then pay some on principal too. So, warning signs that debt may be overtaking your life, or you're losing control of debt, would be late payments, using savings for bills, getting loans from parents. All those things can enter in if you're starting to do that sliding down the slope. We talked about that too. If you're struggling and you can't make a payment, or you're having issues, or you maybe want to reduce your payments, call your creditors. Don't ignore it. Don't leave town. Don't do any of those things. Call them and say, hey, I want to pay. I want to pay you off. I'm having some adjustments. I got into too much credit, or my job changed and my pay has dropped, I'm not working as many hours, whatever. Don't ignore it. Consumer buying strategies when you're getting ready to buy a home or any purchases, large purchases that we look at, we go through or should go through an information gathering stage. What's going to cost? What's the best cost? What's the whatever? Where do I want to live? How do I want to? What size house do I want? What kind of appliances do I want? Etc. We look at alternatives. We look at then we purchase, and then we have post-purchase things that happen. We have warranties and those kind of things. So that all lumps into that's how the phases are for buying big things. Um, Impulse buying is an unplanned purchase. Shopaholics fall into the impulse buying real quickly, but all of us can. You're out with friends and you find something and you think, gosh, that's great. I want to buy that. I bought a bowl at an antique store that I fell in love with. Bought it on impulse. I've had the hardest time figuring out how to use that bowl when I got it home because it was an impulse thing. It wasn't something I needed. I just fell in love with it when I saw it, and I do still love it. There's nothing wrong with that, but it was just funny because I thought, what did I buy this bowl for? So it happens to the best of us. Store brands versus national brands. We talked about that, especially like with appliances and things. A lot of store brands are national brands with the store label on them. So do a little research and find out if you're buying. The example I think I used was Sears, which I don't think is in business anymore, but figure out who's Lowe's brand, who's making the Lowe's brand. And if you buy the Lowe's brand, it's probably cheaper. But it's still the name brand that you're looking for. So that can make a big difference when you're doing that. And sometimes people want the national brand. They're very hung up on that, and that's fine. But just know you're probably going to be paying extra for the national brand label on there. Always beware of scams. Just sound like your parents and your grandparents. Anybody that calls you and wants a gift card, crypto payment, they want to be paid by a gift card, cryptocurrency, are probably fake people. It's probably a scam on the beginning. There also are fake online sellers. A lot of people talk about, they buy something on Marketplace, Facebook, and the person never shows up, the item never shows up, whatever. But when they go to the person's house, they don't have it for sale. It was just all a scam. So just beware of those things. And you think, oh gosh, I'll never fall for that. I've had friends who are very intelligent, who know these things, who have fallen prey to these things because it's just that thing they call. They're from the electric company. They're going to shut off your power. They need to be paid right now. They need to be paid in gift cards, and they have the information. They have your address, your name, it's not just like they call up randomly and go, hey, I'm going to shut off your power. So you just need to be aware that those things are out there. And again, if you have a question, call them back. Call the company back on the number that you have for the electric company. Call the credit card people back on the number you have for the credit card. So don't fall victim to somebody pressuring. Pressuring is usually the big key in anything, emails, everything else. If it's got to be done right now, that's probably a red flag. Not that they don't shut your power off right then, but they don't want to be paid in gift cards. So they just need cash. So those things can happen. So just beware of that. As consumers, we have protections, class action suits. Class action suits can happen if there's more than one of you that have the same issue, not just two, but sometimes probably I think they can have them as small as 5. And then that gives them the reason to file for a class action suit. You all have had the same thing go wrong, or the exact same bad customer service, or the exact same whatever result of something bad. So that can happen with a class action suit, and that can provide you some legal protection. There's also consumer protection laws out there that help resolve disputes, that protect the consumer from bad trades on the side of the sellers. We got into renting. For housing, renting versus buying. Renting, of course, has lower upfront costs. It's flexible. You have less responsibility. Buying builds equity. You have tax benefits, and it's a long-term commitment. Condos give you the option of owning a unit, but you don't own the whole building. So it gives you pride of ownership, but you're not responsible for the whole building. And I like to think of that because there's all kinds of condos out there that you think, well, I share this and share that. A lot of condos, when they show in the the book or things that are for sale, I think of like at the beach. And, those are all condos that are basically like 2 and 3 and 4 bedroom apartments. You can buy a condo there. You're only responsible for your stuff in that building. And you can think of that building then as responsible for maintaining the pool, maintaining the elevator, maintaining the outside areas, the, stuff like that. So it kind of gives you, quote unquote, the best of both worlds by doing that. Ownership costs of buying a home, it's kind of expensive. Your major expenses are going to be real estate taxes because those are going to go up every year and they're expensive to begin with for most places. Some states don't charge real estate taxes, so if that's really important to you, you might look at getting a job in those areas when you get ready to buy your house. Of course, there's maintenance on a house because you're the one that's responsible for maintaining it, so you've got to either pay or do it yourself. And then there's insurance to cover everything. And if you have a mortgage, you have to have insurance. So it's like when you buy your car. If you buy a car, you have to have insurance. So it's not like you can say, well, I'll just forego the insurance for a few years, it'll be fine. You have to have it. They require it, so it is a cost too. Conventional loans equal month have equal monthly payments. That's what we think of most loans for mortgages. You're paying $1,200 a month for 30 years. It may go up because of real estate fees if you lump all that in there, or real estate taxes or something like that. But the interest and the principal and all that has been factored in there, and it's $1,200 a month no matter what. Um, VA loans help veterans. Um, you can refinance when the rates drop. I don't believe the test asks for a question, but it's about 1% if they drop 1%. To wrap up, credit, always use it wisely, understand the costs. If you get in over your head, rein it in, pay it down, and start over, knowing your what happened before. Shop smart, avoid scams. Of course, that's important for us as consumers. Housing, look at renting versus buying carefully. Renting has had a bad rap, and people always said you need to get out of school and buy a house. That has shifted with the rise of homes and the not rise of our salaries to rise exponentially the same with housing. So a lot more people are renting, and I get it. When something breaks and you're trying to find who's the plumber and the last plumber we used is retired, you're left at a thing trying to go. It'd be so nice just to go, excuse me, this is Robin, and I need somebody to come up and take care of this, because that is the nice perk. So just weigh those things and decide what's best for you. The test is open, as noted, for the dates that are noted on the uh, test parameters divisions. There are 50 questions, multiple choice, true, false, open note, and it's in honor lock. And if you have any questions or have any issues, please give me a call. Good luck.